history gives us a fascinating window into the hoops people will go through to save on taxes. In their 2021 book, Rebellion, Rascals, and Revenue, two economists uncover some of the weirder ways that taxes have shaped our society. You see, governments are always looking for ways to get more cash out of their citizens, and citizens, likewise, are looking for ways to hold on to their cash. And sometimes the results can be pretty ridiculous. One of my favorite examples is England's window tax. Back in 1696, King William III imposed a tax on windows. At the time, glass was expensive, so he reasoned that more windows meant richer owners who could afford higher taxes. Now, unsurprisingly, people started bricking up their windows to avoid paying the tax. Charles Dickens called it a tax on air and sunlight. Now, common sense eventually prevailed, and the tax was finally abolished in 1851. This was 155 years later, though, and many buildings still bear the marks of this 18th century tax avoidance. Take a bus tour in London, you'll see this everywhere. These days, boarding up your windows, though, won't help you with the CRA. Thankfully, there are other legal ways to reduce your taxes that might be just as effective. The nice thing, too, is that you don't need to be mega wealthy for these things to work. So let's run through the next 5 most common ways to reduce your taxes so that by this time next year, you're putting yourself in a better position. If you're picking up where we left off, we've already covered the top 4. I'll put a link to that video right here in case you missed it. Again, if we haven't ever met, my name is Steve Willems. I'm a wealth advisor with the Willems Wealth Planning Group out here in BC. We started this channel to help you plan for your own retirement, helping you plan your investments, your income streams, and ideally have you pay less tax along the way. So let's dive in. The 5 things you can do now to pay less taxes next year. Up first, charitable donations. Donating to registered Canadian charities provides a non-refundable tax credit. These credits are really valuable for high-income earners as they reduce the amount of taxes that are going to be owed. As an example, again, let's say you make $250,000 here in BC, and then you go and make a $30,000 cash donation, let's say to your local hospice or community foundation. That's going to save you $13,688 on your tax bill. Now, why does the government incentivize this? Why do they actually want this? Why do they give you a credit when you give to charity? Well, it turns out the government actually wants you to give your money to charity. You see, charity is way more efficient than government. Often, there's work being done by highly motivated volunteers. If a problem exists and a charity can solve it, that problem can get solved at a much lower cost than what the government would incur if they were to solve it. And that's why they really don't mind you donating your money. They're willing to reward you for that kind of behavior. Up next is the idea of tax loss harvesting. Now, this involves selling investments at a loss to offset capital gains in other investments, which allows you to reduce your overall capital gains tax. So let's say you have one investment, let's say a Bitcoin fund, and it has a $10,000 capital gain, and another with a $10,000 capital loss, let's say a Peloton stock. Now, these gains and losses are only paper gains and losses until you sell them. We call that a disposition. It's triggered or realized on the day that that thing, that fund, that ETF, that security, whatever it may be, is sold. And the CRA will receive all of the gains and losses in a year, and you'll pay tax on the net of all of that activity. More gains than losses, you're going to pay a bit of tax. More losses than gains, you're going to have a capital loss carry forward to apply to gains in the future. So if you were already looking to sell the one holding with a gain, in our example, the Bitcoin fund, because you wanted to prune some profits or reposition it elsewhere, it's helpful from a tax perspective to pair it off against another holding with an unrealized loss. When you do so, you'll net out the tax on the transaction down to $0. Pretty simple, right? Well, there's even more that you can do. You see, the CRA prohibits you from selling and then repurchasing the same investment within a 30-day period, if you want to, in fact, claim the loss. But what you can do is purchase a similar investment. What this potentially allows you to do is to sell some investments, claim a loss, and then repurchase a similar investment while, and this is important, maintaining your overall portfolio balance. So as you can imagine, tax loss harvesting is a more complex strategy. Whether it makes sense for you will depend on your portfolio, your goals, and what's going on in the market. But if you haven't considered it before, it's worth taking a look at. Third is the spousal loan strategy. Loaning money to a lower income spouse for investment purposes can reduce the family's overall tax burden. Now, if you're doing this strategy, the loan must be at what's called the prescribed rate, and that rate is set by the CRA. It's actually declared on your tax return too. So functionally, what you do is you give your spouse a chunk of money for them to invest, and then they have to pay you back interest. And that interest is going to show up on your tax return. Now, sometimes the tax that you'll pay on the interest of that internal loan will be less than the growth on the investment gains you lent, in which case this might make sense. But frankly, this used to be more popular than it is today, given the rate on those prescribed loans has increased with the hikes to the overall interest rates across the country over the last number of years. And so we just really aren't seeing this nearly as often as we used to. For business owners, carefully tracking and deducting eligible business expenses can significantly reduce taxable income. Eligible home office expenses, tracking mileage for vehicle use, travel-related expenses. There's a whole host of tax savings here if you're willing to take the time. A couple keys to getting this right, though. One, you'll want to be working with an accounting pro who will give you the time and attention to find any missed opportunities. Every few years, it's good to go back through the bank records and see if anything's being missed. And then two, once you're aware of the key expense deduction categories you want to be optimizing for, it's good to set up a system so that you can keep your records clean. Today, there's a pile of tech that can help you with this. Apps to track mileage, automatically categorize expenses, automated bookkeeping services that use kind of optical text recognition or OTR. Suggest you use those tools so this process doesn't feel nearly as much of a burden. Now, fifth and finally, IPPs or individual pension plans. They can be an effective tax reduction method for high-income business owners and incorporated professionals here in Canada. IPPs allow for higher contribution limits compared to RRSPs, especially for individuals over the age of 40, making them ideal for ideally late career, high-earning folks who are looking to catch up on their retirement savings. Now, these IPPs, they're legitimate, legal, standalone pension plans, but you're the only pensioner under the plan, typically. So contributions to an IPP are tax deductible to your business, and the retirement income is deferred until the pension is accessed. This can offer pretty significant tax deferral advantages. So for some business owners or professionals, they'll use this as a way to unlock additional tax-deferred savings. Now, often when we chat with people, they think they've got their whole situation totally buttoned up, and it just takes us often a few minutes to find a couple hidden opportunities that have been hiding in plain sight all along. If that's you, boarding up your windows, that's not going to help. If you'd like a hand making sure that you're not missing any opportunities, we set aside a few time slots every week to help people who we aren't already working with save on taxes. If you'd like to grab one of those time slots, I'll put a link in the description below. Hope that helps you think through your own journey. Thanks for watching. I'll see you in the next video.